Welcome back. You're watching To The Point. The Greek crisis is front-page news, and there's every possibility that if Greece votes no on Sunday's referendum, it could get worse. So the question we ask tonight is, what impact could that have on India, on capital flows, on exports, on the rupee, and on growth? And beyond that, what steps should the government be considering to strengthen India's defences? With me is the former Deputy Governor of the Reserve Bank and the Present Director of Research, Brookings India, Subir Kulkarni, former Chief Economic Advisor, Arvind Virmani, and the Chairman of Oxus Investments, Surjit Bhalla. Gentlemen, let's start with the areas where the present crisis in Greece could adversely affect India. Surjit Bhalla, as interest rates rise in Europe and as people seek safe havens like US Treasuries, what sort of outflows of capital do you anticipate out of India?
Not much, actually, Karan. I think, this crisis is going to be likely to be substantially different than the global financial crisis of 2008-9. At that time, very rightly, interest rates went up, capital flew out of all the markets, and if you will, the rest, as they say, is history. This time, the contagion will be a lot less and will be contained within perhaps a few countries of Europe. Now, after having said that, we should all remember that this is a political economic process and there is uncertainty. But if you're asking to make an expected forecast, I would say that this time it will be substantially different than 2008.
Subir Kulkarni, you've heard a certain measure of reassurance in that answer from Surjit Bhalla, but there are many others who fear that the capital outflows could be fairly substantial. To what extent does India have record resources at the moment at $355 billion that could give us a cushion of comfort?
I think the two factors that give us some comfort. One is, of course, the reserves that you mentioned. They're pretty large. But more importantly, over the last 2 years, the current account deficit, which is the ultimate measure of external vulnerability to external shocks, has narrowed considerably. A number of measures that the government took in 2013 to restrict gold imports and so on. But most importantly, over the last 7 or 8 months, oil prices having come down so sharply, other commodity prices having declined. Now, we still have an export problem. Our exports have been declining over the last 6 months. But at the end of the day, our current account deficit is less than 2% of GDP. That, to me, is the single most important reason for reassurance. I agree with Surjit's assessment that I don't think the impact is going to be very severe. It could be there, but it's not going to be dramatic. And the main reason for that, I believe, along with the reserves, which offer a measure of protection, is the low vulnerability that the current account deficit now poses.
Arvind Virmani, let's come to the impact the Greek crisis could have on India's exports. Now, Greece itself last year only accounts for some 0.11% of Indian exports, but the European Union as a whole accounts for something close to 15.88%. If growth in countries like Germany, France, UK gets affected as a result of Greece, what impact would that have on our exports to the European Union as a whole, and would that be a cause of concern for you?
Yeah, so there are two parts to it, and I would very quickly step back about a month back, where actually there were signs of European recovery, and capital actually, there were indications that capital may flow out of India and other emerging markets to Europe. So in fact, on the capital flow front, you could have an inverse. If Europe is doing badly, there's no question of capital flowing out of India to Europe. It may actually start flowing back. So that's just a little twist on the tail. Of course, there are always liquidity issues with banks in Europe, etc. But I think they are pretty well organized now. So
come to exports.
They won't sell liquid markets like India.
Come to exports.
Right. So as far as, so the second part of that is the inverse is exactly negative. Europe's recovery is probably going to be slowed down because of the Greek crisis, and therefore all exporters to Europe will suffer. That's correct. But I think the US recovery is actually a more important factor in the exports from India. But clearly, if Europe falters, which is likely, then exports to Europe will be affected.
Sujit
But
Bhalla,
as I said, there are many other compensating
Sujit Bhalla, beyond the impact on capital outflows and the impact on exports, there's also the indirect impact on the Indian economy of what I call international global volatility. First of all, is there any danger of another major Western bank collapse on the horizon, a repeat of the Lehman Brothers crisis, or do you rule that out entirely in this case?
No, I come close to ruling that out entirely. Look, Greece is a very small, if you will, cog in the wheel of the crisis. You know, the Lehman crisis engulfed American banks, engulfed Canadian banks, engulfed European banks. This time they've had, if you will, 4 years of preparation for handling Greece. So I think the two are just not comparable. And, you know, we might all be very surprised as to how insignificant the effect is on the world economy and, if you will, on the European economy itself. There is a significant effect, if you will, if the Greece was to exit from the euro, which I don't think is likely, but nevertheless we'll have to wait for the referendum on Sunday in order to be certain about that. But really the political knockout blow that the European Union will get is of lot greater significance than any economic fallout.
You heard Sujit Bhalla say that he doesn't believe Greece will eventually leave the European Union, or at least the European money zone, on Sunday. But that is something that he's speculating about. Many others believe there's a good likelihood it could. If Greece does leave the Eurozone, is there a danger that countries like Spain, Ireland, Portugal, perhaps even Italy, all of whom have similar sort of problems, maybe not as bad, but at least that sort of problem, that they might follow suit?
Well, let me also address the question you asked, Surjit, which is the risk of a financial sector meltdown. What's happened over the last 5 years, and perhaps this is in a sense the saving grace of this whole Troika program, is that Greek debt, what Greece owes to the rest of the world, has moved from private banks mostly to the public sector now, public and quasi-public, so governments and central banks. And so that actually has insulated the private financial sector from the risks or the threats of a Greek
Paris
meltdown.
and Berlin and other European capitals will take a direct hit, but the private banks won't.
That's right. So as a percentage of exposure, it's more on the public sector balance sheet than on the private sector balance sheet. So the banking system, I don't think, is vulnerable to any turbulence.
What about the danger that if the Greeks opt out, it might send a signal to the Spaniards, to the Portuguese, to the Irish?
There is a contagion risk, which is why I think the Europeans have been so focused and so dedicated to trying to keep Greece in place. But I think the difference is that these countries, Ireland, Spain, Portugal, Italy, have gone through significant adjustments to an extent that Greece has simply not. Greece has been declining every year, 25% lower GDP today than it was 5 years ago. That's a massive decline and still isn't enough.
That's not true of the other countries.
The others have gone through this, but they've also adjusted in terms of wages and so on. Some signs of recovery starting to show up there. A little different situation.
So the corollary to your argument is there's no point speculating and asking what would be the impact on India if the contagion spreads within Europe, because you think it's unlikely to happen anyway.
I think at this point the others feel that it's in this situation in their interest to remain in the group. For Greece, I think it's a toss-up, which is why we have the referendum coming.
Let me put this to you, Mr. Virmani. I know that you think that there's a possibility there could be capital inflows rather than sizable capital outflows. But if in fact people seek safe havens in US treasuries and there is a sizable outflow, will that also have an impact on FDI flows into India? Will India as a destination for foreign direct investment diminish, and will that in turn adversely affect both Mr. Jaitley and Mr. Prabhu's investment plans?
As I said earlier, it's really connected to global GDP. And so you can think of it as what is the effect on the US and what is the effect on Europe. We've already talked about the effect coming from Europe. The euro area, certainly the growth will slow down. Their investments will probably slow down. But there's a double-edged sword here. A lot of companies in Europe are doing fine. They are still looking for opportunities abroad and would continue to come to India. There may be others who will cut down on investment, including FDI. As far as US is concerned, there's another possibility which you haven't considered, which is that if Europe's growth slows down, then the whole interest adjustment which the Fed is contemplating and people have been predicting happening in September may actually be postponed, which will again be good for India. You know, instead of what everybody has been worrying, that there could be a capital flow to the US, that delay will mean the opposite. That means more capital may flow into India. So I'm kind of giving you a kind of a different perspective from
absolutely. What you're doing is you're seeing many silver linings to this cloud. Sometimes, in fact, the cloud is disappearing behind your silver linings.
No, I'm giving you opposite. I'm not even talking about silver lining. I'm giving you the opposite view from India's perspective.
Let me, Surjit Bhalla, put this to you. I know that you've heard Subir Gokaran say a moment ago that one of the great assuring factors at the moment is India's very small CAD, the current account deficit. But what would be the impact if the dollar were to strengthen sizably, and would that hurt us in particular as sizable importers of oil, or are we cushioned by the fact that our oil is costed in a basket of currencies rather than directly in dollars? What would be the impact therefore on the CAD and on oil imports of the dollar strengthening sizably?
Well, you know, there is a funny, if you will, an inverse relationship. If the dollar strengthens, the price of oil in dollars will go down. That's been the typical pattern. So really, you know, it's our current account deficit, as Subir said, is in very good shape. Is really, Greece is not a factor, and if you will, neither is the US dollar strengthening in our current account deficit going down. You could argue if the dollar strengthens, the rupee weakens, that helps our exports. So really, this one, I would say that the situation, plus let me just say that I think as far as the global economy is concerned, which is where our exports, if you will, are most dependent on, I think the global economy is on its way up rather than its way down. Greece will maybe have a temporary, a very, very short-lived blip down, but really the global economy is in very, very good shape. And if you will, I would say that the, you know, apart from the political problems and between the creditors as well as Greece, that the European Common Union has really, if you will, handled the crisis quite well, and will continue to do so, in my opinion. The central bank, the European Central Bank, will step in order to contain any real contagion. And so in that sense, I think, you know, this crisis, while on the surface looks like 2007-8 or 2008-9, it's radically different.
You know, we're reaching a very interesting conclusion in this discussion, that we began by asking what would be the impact, how adverse would it be. We're coming to the point where some people are suggesting that actually there could be a smile on our faces as this crisis plays out, because for many reasons India could be an area where people would choose to invest because Europe has gone down, because the Americans have surplus cash and don't know what to do with it. And this reminds me of a commitment that this government has made, which was reinforced this morning in an interview that Arvind Panagriya, the Niti Aayog chairman, gave, that he's confident we're going to see 8% growth this year. With the Greek crisis, with the impact that could have on capital flows, on exports, the wider global financial uncertainty, do you think his confidence that we'll achieve 8% is real? Or would you there say there must be some question marks at least?
No, I think the determinant of India's acceleration is going to be what the Indian government does, what Indian policy does. Yes, Greece is a potential threat, particularly if there's contagion. I think if Greece is contained, its impact on India is going to be relatively small. There may be some temporary turbulence, but it's not going to affect the long-term picture. But what are we doing with respect to infrastructure? What are we doing with respect to our agricultural sector? Those are the constraints to growth.
Greece is not going to affect
Greece
that 8%.
Is not going to, so the compulsion to reform remains as strong as ever. In fact, if we're seeing some global turbulence, that compulsion becomes even stronger. I think that's what we should be focusing on. You know, if Greece is contained, its impact, you know, it's a horrible story for Greece, but its impact on India, I think, is limited. If it spreads, that's a different story. You could have much more turbulence globally, but I'm not visualizing that as a high probability scenario at this point.
In which case, gentlemen, we come to the second part of our discussion, and only very briefly, because I was going to then ask you what is it that in fact the finance minister and perhaps the RBI governor should be doing to strengthen our defences. But I get the feeling, and I'll start with you, Mr. Virmani, that they don't need to do very much. Am I right in coming to that conclusion, or am I being hasty?
No, I disagree slightly with both Surjit and Subir on the growth impact. Actually, the debt default has already happened in Greece. There will be some form of Greek exit. You know, it turns out that the euro has no rules for exit of any member country. So it's going to be a mess, and it will have an effect on the southern countries, on Italy, Spain, and Portugal, and possibly even France. So I do not agree that there will be no effect on growth in Europe, and that will affect India. But the order of magnitude of that effect in the medium term, I would say, is something like 0.1 or 0.2% of GDP. So I'm not that sanguine about the long-term effect. I think
can I interrupt
playing
there?
Out badly.
Can I interrupt there? Are you therefore saying that the target of 8% for this year, which Arvind Panigrahi was confidently asserting in the papers this morning, is now questionable?
Yeah, so my first part was on the short-term effects, where I was very optimistic, but on the medium-term effects, where growth of Europe, I think, will be affected, I think there could be negative effects on India, yes.
In which case, very quickly again, what steps would you like to see Finance Minister Jaitley or Governor Rajan take to strengthen our defences?
Well, there I think all three of us agree. We've got to accelerate whatever reforms we are doing. A lot of people have been saying that to some extent there is a little more of talk than of action. We need to change that ratio, certainly. So more action on all the reforms that I think all three of us more or less agree on. So, as they say, a crisis is too much of an opportunity to waste. So I would suggest they use it in that manner to accelerate whatever they are doing.
Earlier this evening, Moody's, in fact, has issued a statement to say that they are disappointed by the slow process of reforms in this country. They've even said that they believe multi-party democracy is holding back economic reform in India. With that in the background, and with whatever need there is to take action to prevent the Greek crisis affecting us, what would you like to see Finance Minister Jaitley do? Or do you believe there's not much that he needs to do?
No, who said this? Who made the statement that multi-party democracy is holding back?
Moody's this evening.
Okay. Yeah. Well, I completely disagree with what Moody's has said, and there's a lot of record about how they're not inaccurate. There's no such thing as too much democracy or too much.
Let's leave Moody's out of it. I was only quoting Moody's. My question really is, what steps would you like to see Arun Jaitley take, or is there no need for him to do anything special at this point?
No, I think, exactly what everybody else is saying. We need to take the steps that the government promised that they would take. They would bring out economic reforms in order that we accelerate our growth process and, if you will, reduce poverty and all the rest of it. I think there is some acceleration underway. I think the 8% will be achieved. I would like to see interest rates cut faster. But I do think that we are in a good patch of the economic cycle, and economic reforms can only help. So it's one last thing that I want to say on the Greece thing before we completely leave it aside.
Very quickly.
The Greek exit, the exit of Greece will only happen if there is a no vote. All the
absolutely, but we know that. We know that. You're repeating. Forgive me, I'm stopping you because you're repeating what we know. That's the purpose of the referendum, so I'll stop you there because you're repeating what we know. I'm going to come back very quickly to this point made by Moody's and whether in the light of that, there's things that Mr. Jaitley needs to do. Modi has expressed disappointment. It will be picked up internationally. It will reinforce the belief that many people have that this government is not delivering on its promises, and that's a belief that investors here have and investors abroad have. In the light of that and this possible danger that we want to stop of contagion hitting us, are there things our finance minister should be doing?
Well, I think some of the budgetary promises, for example, the higher commitments to capital spending, to investment infrastructure, both directly out of the budget and the contribution to the National Infrastructure Investment Fund. That was an institutional mechanism which I believe offers the potential to take us out of this horrible infrastructure slump that we're in. We need to operationalize that. It's 3 months after the budget and we haven't seen any word on how this is going to move forward. So money going into infrastructure is of critical importance now. That is the biggest growth constraint to us. And if investors, domestic and foreign, see this happening, see credible movement in infrastructure, I think that's going to change the mood. Other things need to be done, but I think that's the number one problem that needs to be addressed.
But the interesting thing is that 3 months after the budget, he hasn't delivered on that key promise of infrastructure investment, because that was a very important part of the engine of growth that he's put in place to achieve 7.5 or 8%.
So that's where I think, you know, we should be focused on what we should be doing here and worry less. Yes, it might have an impact temporarily, but that's not, Greece is not our number one problem. The absence of movement on infrastructure, I think, is our number one problem.
Concentrate at home. That's the best defense to keep,
I believe so.
Contagion out.
Keep that confidence alive. I think that's the most important thing the government can do.
My thanks to you for coming to studio, and thank you for helping us with this understanding of what Greece means for India, and more importantly, the reassurance that it may not mean very much.
Well, let's hope we're all right. At least
fingers crossed. And my thanks also to Sujit Bhalla and Arvind Rani for joining me on that rather reassuring note that the crisis in Greece could not necessarily become a crisis for us. We end this particular episode. If you have been, thanks for watching. Goodbye. Good night.